A house can be the best financial decision you'll ever make, or the most expensive mistake you'll never realize you made. What's surprising is that both outcomes can start with the exact same salary, the same savings, and even the same house. Alex and Ryan didn't know that. At 30 years old, they lived in the same city, earned the same income, and had spent years saving for what they believed was the next logical step in adulthood. Neither of them was reckless. Neither of them was financially irresponsible. In fact, both had done almost everything right. And yet, 20 years later, one of them had a significantly higher net worth, more freedom, and far less financial stress. The difference wasn't how hard they worked. It wasn't luck. It wasn't even how much money they earned. It came down to one decision they made before signing a stack of papers. Because buying a house isn't just buying a place to live. You're buying a financial strategy. And like every financial strategy, it has hidden costs, hidden risks, and hidden opportunities that most people never calculate. Here's what happened. In 2026, Alex and Ryan were both 30 years old. They each earned $85,000 a year. Both had managed to save $70,000 after years of disciplined budgeting. Neither had children. Neither carried credit card debt. Both had stable careers with similar growth potential. On paper, their financial lives were almost identical. Then they found the same type of home. Purchase price, $500,000. The monthly mortgage looked manageable. Interest rates had become more attractive than they had been just a couple of years earlier. Friends congratulated them. Family members said the same thing. Stop paying someone else's mortgage. It sounded like common sense. But Alex paused. Not because he thought buying a home was a bad idea. Because he wondered if it was the right investment at the right time. Ryan didn't hesitate. To him, owning a home meant stability. No landlord. No rent increases. No uncertainty about having to move. Most importantly, it felt like becoming a real adult. Neither decision was irrational. In fact, both were supported by perfectly reasonable arguments. That's what makes this story interesting. Ryan bought the house. He made a 20% down payment of $100,000. Since he only had $70,000 saved, he waited several more months, saved aggressively, and finally closed on the property. His mortgage payments were predictable. Every payment increased his ownership a little more. Instead of sending money to a landlord, he was building equity. Psychologically, this felt incredibly rewarding. Behavioral economists call this the endowment effect. People naturally value things more simply because they own them. Ryan wasn't just paying for shelter anymore. He owned an asset. Every improvement he made felt like an investment in himself. His home became more than a place to sleep. It became part of his identity. Alex chose differently. Instead of buying immediately, he rented a similar home nearby. His monthly rent was lower than Ryan's total monthly housing costs once property taxes, insurance, maintenance, and HOA fees were included. The difference wasn't enormous, but it existed. Rather than letting that extra cash disappear into everyday spending, Alex created an automatic investment plan. Every month, the savings went into low-cost index funds. No stock picking, no market timing, just consistent investing. It didn't feel exciting. Actually, it felt boring. But boring decisions often produce extraordinary results over time. At first, Ryan looked like the clear winner. His home's value increased during the first couple of years. Neighbors celebrated rising property prices. Real estate websites estimated his home's value almost every month. Watching the number climb felt satisfying. His net worth appeared to be growing without him doing anything. Alex, meanwhile, opened his investment account and sometimes saw the opposite. Markets moved up. Markets moved down. Some months his portfolio lost money. Other months it recovered. Emotionally, Ryan slept better. This is where psychology quietly enters the picture. Human beings dislike visible losses far more than they appreciate equal gains. It's called loss aversion. A falling investment account feels painful, even when history suggests markets have recovered from downturns over long periods. A home doesn't send daily price updates. Stocks do. Ironically, one investment feels safer simply because its price is hidden most of the time, not because it's actually less risky. By the end of year one, both men felt validated. Ryan had a growing sense of pride every time he unlocked his front door. Alex watched his investment account slowly increase while enjoying the flexibility of renting. Neither believed they had made a mistake. Then something changed. Ryan's water heater failed. A few months later, part of the roof needed repairs after severe weather. Together, the unexpected bills totaled nearly $11,000. Nobody had mentioned these costs during the house tours. Because they aren't part of the selling process. They're part of ownership. Ryan paid the bills. After all, that's what homeowners do. Nobody had mentioned these costs during the house tours because they aren't part of the selling process. They're part of ownership. But those repairs delayed the extra investing he had planned. Alex faced none of those expenses. When his apartment's air conditioning stopped working one weekend, he called the property manager. By Monday afternoon, it had been replaced. His financial life continued uninterrupted. It sounds like a small difference, until you repeat that difference over 10 or 20 years. Here's what almost nobody talks about. The true cost of owning a home isn't the mortgage. It's everything surrounding the mortgage. Property taxes, homeowner's insurance, routine maintenance, unexpected repairs, furniture, appliances, landscaping, utility costs, closing costs, opportunity cost. Individually, none of these seem overwhelming. Together, they quietly reshape your financial future. Financial planners often use a simple rule of thumb. Expect to spend around 1% to 2% of a home's value each year on maintenance and repairs, although actual costs vary by the home's age, condition, and location. For a $500,000 home, that's roughly $5,000 to $10,000 every year. Some years you'll spend almost nothing. Other years you'll replace a roof, HVAC system, or plumbing. The average smooths out over time. Ryan wasn't losing money. He was simply discovering the expenses that rarely appear in glossy real estate advertisements. And Alex was about to discover that renting had hidden costs of its own. Alex watched Ryan write another check for home repairs, and for a brief moment, he felt relieved that he had chosen to rent. But relief has a way of turning into overconfidence. And that's where many renters make their biggest mistake. Because not buying a house doesn't automatically make you wealthier. It only creates an opportunity. What you do with that opportunity is what matters. Every month, Alex's housing costs were lower than Ryan's by several $100s after accounting for the mortgage, property taxes, insurance, and maintenance. Instead of letting that difference disappear into restaurant meals, vacations, or a nicer car, he automated it. The money flowed into low-cost index funds before he even saw it. It wasn't exciting. It wasn't glamorous. But it removed emotion from the process. Behavioral economists call this a commitment device, a system that protects you from your future self. Because the greatest threat to long-term wealth usually isn't the market. It's your own behavior. By year 3, something unexpected happened. Ryan's home had appreciated. On paper, it was now worth around $560,000. Friends congratulated him. He felt richer. And technically, he was. But there was one problem. That wealth was trapped. To access it, he'd have to sell the home, refinance it, or borrow against it. His house was becoming more valuable, but it wasn't improving his monthly cash flow. Alex's investments told a different story. The market hadn't moved in a straight line. There were corrections. There were headlines predicting recessions. There were weeks when fear dominated the news. But Alex kept investing anyway. Not because he knew what the market would do next. Because he knew he didn't. History has repeatedly shown that missing just a handful of the market's strongest days can dramatically reduce long-term returns. Trying to perfectly time the market is a strategy that has defeated professionals for decades. Alex stopped trying to predict the future. He simply kept buying. Ryan couldn't ignore what was happening around him. Neighbors were renovating kitchens, adding patios, building home offices. Real estate agents kept saying one phrase: it's an investment. And technically, they weren't wrong. But psychology quietly entered the picture again. This time, it was status signaling. Humans naturally compare themselves to the people around them. When everyone upgrades, doing nothing starts to feel like falling behind. Ryan remodeled his kitchen, not because the old one stopped working, because it suddenly felt outdated. The renovation cost nearly $28,000. Would it increase the home's value? Maybe. Would it increase his monthly payments? Absolutely. Meanwhile, Alex was facing a different psychological challenge. His landlord announced a rent increase. It wasn't dramatic, but it was enough to make him question his decision. What if Ryan was right? What if I'm wasting money? These questions weren't based on spreadsheets. They were based on emotion. Homeownership provides something markets never can: certainty, or at least the feeling of certainty. And sometimes that feeling alone is incredibly valuable. Then everything flipped. Year 5 brought a recession. Companies slowed hiring. Markets dropped sharply. Consumer confidence weakened. For the first time since Alex started investing, his portfolio lost a significant amount of value. Watching years of gains disappear in months tested his discipline. This is where many investors quit. Not because investing stopped working, because fear became louder than logic. Behavioral researchers have found that people often experience the pain of losses much more intensely than the pleasure of equivalent gains. Selling during panic feels emotionally safe. Financially, it can be devastating. Alex wanted to stop. He wanted to wait until things felt normal again. But normal never arrives during a recession. Instead, he continued investing every month. The shares he bought during the downturn would eventually become some of the most valuable purchases he ever made. Ryan faced a different kind of stress. Housing prices in his neighborhood stopped climbing. Some homes even sold below expectations. Suddenly, the idea that real estate always goes up didn't feel quite as certain. But unlike Alex, Ryan couldn't simply ignore the market. He still had a mortgage payment due every single month, regardless of what his home's market value happened to be. Here's what nobody talks about. A house is both a home and an investment. Those two roles don't always work together. As an investment, you'd want to buy low, sell high, and stay objective. As a home, emotions naturally influence your decisions. You paint the walls. You upgrade the bathroom. You choose the nicer countertops. Many of those choices improve your quality of life, but they don't always improve your financial return. That's not a criticism. It's simply reality. Your primary residence can absolutely build wealth over time, but it's different from owning an investment designed purely for financial performance. Taxes added another layer to the story. Ryan benefited from certain homeowner tax advantages depending on his circumstances and local tax rules. When he eventually sold, part of his capital gains could potentially qualify for favorable tax treatment if he met the legal requirements. Alex, meanwhile, benefited from investments held in tax-advantaged retirement accounts, where long-term compounding could grow more efficiently depending on the account type. Neither strategy completely avoided taxes. They simply managed them differently. And tax efficiency, over decades, can have an enormous impact on wealth. It's another reminder that financial success isn't about finding one perfect asset. It's about understanding how different pieces work together. By the end of year 10, the gap between Alex and Ryan wasn't as obvious as either had expected. Ryan owned a home with substantial equity. His mortgage balance had steadily declined. His property had appreciated over time despite temporary setbacks. He had built wealth through forced savings and ownership. Alex's investment portfolio had grown dramatically as markets recovered and years of consistent contributions compounded. He remained flexible. He could move cities for a better career without selling property. He had no repair bills waiting around the corner. From the outside, both looked successful. But beneath the surface, their financial lives were becoming very different. And the biggest differences had nothing to do with dollars. They had everything to do with freedom, flexibility, and the hidden cost of opportunity. 20 years passed faster than either of them expected. Careers changed. The economy expanded and contracted. Interest rates rose, then fell. Markets experienced crashes that dominated the headlines, only to recover again. Life happened. And through all of it, Alex and Ryan stayed committed to the decisions they had made years earlier. The surprising part? Neither of them had made a perfect choice. But one question still remained. Which decision created the better financial life? By year 20, Ryan had paid down a significant portion of his mortgage. His home, purchased for $500,000, had appreciated over time. Depending on the local market, it was now worth roughly $900,000. On paper, his net worth looked impressive. He had hundreds of thousands of dollars in home equity. His monthly housing costs had become more predictable than renting in many neighborhoods. There was comfort in knowing no landlord could ask him to leave. He had raised a family in the same home. His children had grown up in the same neighborhood. Those benefits don't appear on a balance sheet, but they're real. Financial decisions aren't made in a vacuum. Sometimes stability is the highest return a person can earn. Ryan wasn't just buying an asset 20 years ago. He was buying certainty. And for many people, that's worth a great deal. Alex's journey looked completely different. He continued renting for several years before eventually buying a modest home that better matched his long-term needs rather than purchasing as soon as he could. Meanwhile, he never stopped investing. Every month, every bonus, every salary increase. Instead of dramatically increasing his lifestyle, he increased his investments first. That single habit changed everything. If his portfolio earned an average long-term annual return close to historical global stock market averages, while accepting that future returns are never guaranteed, years of disciplined investing and compounding had transformed relatively ordinary monthly contributions into a substantial investment portfolio. What once felt insignificant had become the engine of his wealth. This is the power of compounding. Not overnight success. Not finding the next hot investment. Just giving money enough time to work. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, although there's no strong evidence he actually said it. Whether he did or not, the principle remains true. Time is one of the most valuable assets an investor can own. Then the numbers told a different story. Ryan's largest asset was concentrated in one property. Alex's wealth was spread across thousands of companies through diversified index funds, along with cash reserves and eventually a home of his own. Ryan had built wealth through equity. Alex had built wealth through ownership of businesses. Both strategies worked, but they carried different risks. Ryan depended heavily on one local housing market. Alex depended on global financial markets. Neither was risk-free. Risk never disappears. It only changes form. Then came something neither of them expected. Freedom. Ryan finally paid off his mortgage. The feeling was incredible. For the first time in decades, he owned his home outright. No monthly principal or interest payment. No lender. Just a house that was completely his. It was one of the proudest moments of his life. Alex experienced freedom differently. His investment income had grown to the point where it covered a meaningful portion of his annual living expenses. He wasn't fully retired, but he no longer depended entirely on his paycheck. Work had become a choice instead of a necessity. Both men had achieved financial progress, just through different paths. So, who actually won? It's the wrong question, because the answer depends on something far more important than mathematics. If you value stability, if you plan to stay in one place for many years, if you enjoy improving your home, if you're comfortable with maintenance costs and long-term responsibility, buying a house can be an outstanding financial decision. It builds equity. It creates stability. It can protect you from rising rents over the long run. And for many families, the emotional value is impossible to measure. But if buying stretches your budget, if it leaves little room for investing, if it forces you to delay retirement savings, if your career requires flexibility, or if you're buying simply because everyone else says you should, then renting while investing the difference can be the smarter financial move. Not because renting is magical, because investing consistently can allow your money to compound in ways many people underestimate. Here's what nobody talks about. The biggest cost of buying a house isn't always the mortgage. It's the opportunities you give up if the purchase consumes too much of your income. Economists call this opportunity cost. Every dollar tied up in one decision is a dollar that can't be used somewhere else. A larger down payment may mean fewer investments. A larger mortgage may mean fewer career choices. A more expensive home may delay financial independence. Those costs are invisible, which is exactly why they're so often ignored. Behavioral psychology explains why this decision feels so difficult. Humans crave certainty. We like owning things we can see and touch. A house feels permanent. An investment account feels abstract. We also tend to follow social proof. When friends start buying homes, renting can feel like falling behind. But wealth isn't built by winning social comparisons. It's built by making decisions that fit your own goals, timeline, and financial reality. The smartest financial decisions often look boring. Until 20 years later. Alex didn't become wealthier because he rented. Ryan didn't build wealth simply because he bought a house. They became successful because they stayed disciplined. Ryan consistently paid down debt and maintained a valuable asset. Alex consistently invested and let compounding do the heavy lifting. Discipline mattered more than the initial decision. That's the lesson most headlines miss. Before you buy a house, don't ask one question. Ask three. Can I comfortably afford it? Will I still have enough to invest consistently? And does this decision increase my freedom or quietly reduce it? Because a home should support your financial future, not become the reason you postpone it. The right house, bought at the right time, for the right reasons, can become one of the best investments you'll ever make. The wrong house, bought for status or pressure, can quietly become one of the most expensive financial mistakes of your life. The difference isn't found in the property. It's found in the decision behind it. If this changed the way you think about money, subscribe for more psychology behind wealth and smarter financial decisions. And in the next documentary, we'll answer another question that quietly shapes millions of financial lives. Why two people with the same salary end up in completely different lives.